back to this week's Manager's Thoughts, coming to you from Kelly at Synergy Asset Management. Today is March 24th, 2023, and we are super excited to bring you another week of updates. This week was Fed week, so definitely a big week for the markets and in terms of what markets are expecting over the coming months and even years, with the summary of economic projections that only comes out 4 times a year also coming out this week with the Fed meeting. As of Thursday, March 23rd, the S&P ended down just a slight 0.07%. The NASDAQ ended up 0.96%, and the Dow Jones Industrial Average ended down 0.43%. And we saw positive remarks in the beginning of the week, positive movements in the market, and then that kind of was dampered down by the Fed speaking out on Wednesday, and it closed down quite a bit after the press conference on Wednesday afternoon. For a bit more context here, we have the year-to-date charts for the NASDAQ, the S&P, the Dow Jones, and the 10-year U.S. Treasury yield. You can see the NASDAQ is up the most, up still a positive 12.6%, so pretty good gains there in the NASDAQ. Here we have the S&P 500, just about a 2.8% gain so far this year. Here we have the Dow Jones Industrial Average, 3.3%, as sort of these value industrial stocks have taken a little bit of a hit here. The 10-year U.S. Treasury yield, this is the most interesting part, is down 10.3%. So even amidst rate hikes and continually higher interest rates in the market here, we have seen a good dip here in February towards the end of January. Then we saw a rally, and then mid-March we saw another dip as investors sort of fled to safety after the banking issues as they looked for the safest assets. Moving on from where we are in the markets, we also had the Fed week, right? We had Fed Chair Jerome Powell announce a 25 basis point rate hike. You can see that just slight little bump up in the stairs there, as the Federal Reserve will continue to also quantitatively tighten the Fed's balance sheet as well. So despite loaning out and expanding their balance sheet in the last few weeks, they will be continuing to tighten that down. Both of these changes were pretty expected. However, the language from Powell regarding the ongoing rate hikes changed significantly, which set the S&P 500 down about 1.65% by the close. We'll go into that language a little bit more in the next slides. One of the main language shifts we saw coming from Fed Chair Jerome Powell was that from the January to the March meeting, this key sentence was changed. And so that sentence is that in the January meeting, the committee anticipates that ongoing increases here in the target range will be appropriate in order to get close to that 2% inflation over time. Here in March, though, we saw that he said the committee anticipates that some additional policy firming might be appropriate in getting to that 2% inflation goal. This is a big difference in that ongoing increases means that more rate hikes are likely to come based off of the economic data, is what they would always say. While the March meeting, the sentiment was that some firming might be appropriate, meaning that it might just be a matter of holding the Fed funds rate higher rather than continuing to hike. In addition to that comment change about the additional tightening not necessary, here you can see that Powell was talking about the banking crisis. He used the word banking system is safe many times throughout the press conference, and here's just one instance of it. He said that is why, in response to these events, the Federal Reserve, working with the Treasury Department and the FDIC, took decisive actions to protect the U.S. economy and to strengthen public confidence in our banking system. These actions demonstrate that all depositors, savings, and the banking system are safe, right? So this is a big shift in what they're supposed to be saying, what the government says, what the Congress says, what the FDIC and the Treasury Department and the Fed, really all that implies. All depositor savings are not safe, technically, legally at this point in time. We saw them backstop the SVB failure as well as the Signature failure. All the deposits were going to be recovered there. However, this does not mean that all bank savings beyond the $250,000 limit are safe. Just a really important note that kind of confused reporters and was maybe not as accurate as Powell should have been. Moving into the SEP, or the Summary of Economic Projections from the Fed members, we have here the PCE inflation that Fed members expect versus the real PCE inflation that we've had over the last few years. You can see here that PCE inflation is expected to stay in that 4 to 2.5 range or so in all of 2023, while it moves slightly down to maybe 3.5 to just under 2 in the range of expected inflation, while the actual target 2% inflation is not expected to be hit until about 2025, according to what the Fed members are expecting. Here we have what the Fed members believe unemployment will do at the end of each of these years. They think that from where we were in 2022, we're going to see a rise by the end of the year and then another rise actually in 2024, according to what they expect. Then we'll see, an unemployment rate come down by the end of 2025 towards that longer term average around 4%. Probably the most important of the summary of economic projections is the dot plot. So where Fed members believe interest rates should be, the Fed funds rate should be in the next year, 2 years, 3 years, and in the longer run. You can see here that all of them pretty much agree that by the end of 2023, we're going to have rates stay above 5%, meaning that we're going to either have one more rate hike or keep it steady at where we are at the 4.75 to 5% range. Here we have the 2024 projections, and you can see those are a lot more scattered. So some believe we should keep it above 5% still, and some think we should cut it, below 4%, as many also believe it'll stay around 4.5%. 2025, we see an even more drastic decrease and another decrease towards the longer run expected Fed funds rate. So it's really a big week for central banks. Last 2 weeks have been, and so last week we saw the ECB, the European Central Bank, hike rates again. They only started hiking rates in July of last summer. You can see that there. They were actually at negative 0.5% on their key interest rate. Here you can see that they actually moved it up another 50 basis points there in the last meeting last week. Finally, of the central banks, we also saw a 0.25 percentage point Bank of England rate hike in their key interest rates. You can see that right there. They've actually started their tightening around the end of 2021, so they had really jumped the gun on seeing inflation and seeing the risk that it holds. Their inflation rate is also still above 10% as of February, so they're definitely dealing with a lot more inflation over there in England, but aggressively hiking rates as well. You can see that they're on track with generally the same pace as the US. So it was a really big week for central banks of rate hikes and expectations of the market and how interest rates will act in the next few months, next year or so, next few years. So we look forward to continuing to monitor how economic news comes out, how central banks choose to react to, bank failures, bank uncertainty, and volatility. And we look forward to continuing to monitor diligently to best manage each of our portfolios. Thank you for tuning in to our Manager's Thoughts update this week, and we look forward to providing another update very soon.